Meet Bob and Linda. Bob and Linda have been married for 35 busy years, where they've been self-employed and worked with their 3 kids to build up their business. During that time, they also obtained a rental property that helped them to receive some passive additional income throughout the years. Well, now, Bob and Linda want to sell their business, sell their rental, and move to the suburbs to be closer to their grandkids. Good for you, Bob and Linda. So they hired a rockstar real estate agent to sell their personal residence and their rental property. They hired a rockstar mortgage broker to help them get a really good interest rate on their new house in the suburbs. But they failed to talk to a CPA or a tax advisor on the implications of these different transactions that they'd been going through. Here's what ended up happening. The first thing is the depreciation on their rental property then became subject to recapture. That means that any depreciation that they've taken on their rental property throughout the years now has to be claimed as ordinary income on their tax returns. And because they bought the property over 20 years ago, a good portion of it had already been depreciated. Associated with that is because they purchased it so long ago, their basis was much lower than the sales price, meaning they had a very large long-term capital gain that they had to recognize on their tax return. And finally, because they were self-employed, Bob and Linda had insurance through the healthcare marketplace, and their insurance agent had signed them up for what's known as the Advance Premium Tax Credit. This is a tax credit or a subsidy that the government gives to some people to help them pay for their insurance premiums. And in a normal year, Bob and Linda would have qualified for the Advance Premium Tax Credit with no problem. But because of the depreciation recapture and the long-term capital gains, their income was so much higher that their premium tax credit now became subject to repayment. In fact, their income was so high that not only did they have to repay a portion of the advanced premium tax credit, they now had to repay the entire thing, which amounted to a bill of $19,000 of repayment. All in all, Bob and Linda had to pay $44,000 in federal taxes, and that's above what they'd already paid throughout the year and had withheld from their paychecks. And because Bob and Linda lived in a state whose state taxes are based on the federal tax return, they owed about $10,000 in state taxes above what they'd paid throughout the year. Here are some things that you can learn from Bob and Linda. The first one is ask your insurance agent if you're receiving the advanced premium tax credit if you have insurance through the healthcare marketplace. In some years, it may make sense for you to receive that premium tax credit. In other years, it may be a bad idea. So if you expect to have a higher income than usual and you have this type of insurance, make sure you talk to your insurance people and see if you're receiving that subsidy. The next one is timing matters. If Bob and Linda had just waited a year or maybe even 2 years later to sell this piece of property, they wouldn't have had to worry about any of this. Let me explain. Because they're so close to retirement age, if they had waited until after they retired and were taking out Social Security, Medicare would have been paying for their health insurance anyway, and they wouldn't have had the advanced premium tax credit repayment at all. So there's timing issue number 1. Timing issue number 2 is they didn't actually have to sell their rental property the way that they did. Because of the type of property it is, their rental would have qualified for what's known as a 1031 exchange, where you're able to defer your long-term capital gains by switching the asset that you're selling for a different similar asset. And because Bob and Linda were planning on buying a new rental at their new area anyway, it would have made a lot more sense to do a 1031 exchange than to just sell it outright. And this leads us into number 3. They really should have consulted with a CPA or a tax advisor who would have told them about all these different circumstances and situations that they qualified for. For Bob and Linda, the benefit of talking to a CPA definitely would have outweighed the cost. The moral of the story, don't be Bob and Linda. Make sure that if you're going to get a rockstar real estate agent and a rockstar mortgage broker, you might as well get a rockstar CPA or tax advisor as well. My name's Kipp, I'm a CPA, and until next time, don't be Bob and Linda.